Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. Before we get started, please take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, are for informational purposes only concerning Market Chameleon tools and products. With that, good Monday morning, D.
Good morning, Will. How are you?
Good.
Good morning, everyone. I'm going to share my screen here.
And
And
today we're going to look at how to find options with implied volatility spikes, correct?
yeah, so it was a based on a question that we got from customer, and actually, so this is a question that comes up. Um, how to find options that are shown the implied volatility spike. Okay. So there are different ways to look that up, and I'm going to show one report here we will cover today. However, there are other screeners that we could use depending on what we're looking for. But we're going to cover this one today, which is looking at option volatility moves by expiration. So this is going to look at um, the at the money options implied volatility for different expirations in these stocks because you could have options implied volatility spiking, let's say, in one particular month because something might be happening, um, and a lot of volume is going on, and we'd want to kind of try to see if we could isolate that. So here we're if you go all the way at the top, main menu under options and go to the right, you'll see over here implied vol movers. All right. And this report really can find options where the implied volatility is getting crushed or implied volatility is spiking. But we're going to look at some of the options that had a big increase in implied volatility. So if we before we do a screen, let's just go from left to right and see what these data elements mean. And then we're going to narrow down like some candidates here. So from left to right, we see there's stock symbol with stock name. You have stock price, the price change on the day, and the market cap. What we're going to do is sort these by market cap just to see the top market cap stocks. So you can see here now, NVIDIA shows up at the top with $3.5 trillion market cap. And if I scroll down, you see a lot of NVIDIA and then Apple. So the reason you see here in a lot of NVIDIA is because NVIDIA has different option expirations. And since we're doing our search based on the at the money implied volatility by the option expiration, we're going to see the different at the money implied volatilities. So here you see November 22nd, November 29th, December 6th for NVIDIA. Next to it, just for convenience, we put the number of days to expiration. And then the next column shows us the at the money implied vol. So November 22nd, the at the money implied vol is 87.7. And then what is the change, right? So how do we know if it's spiking or if it's getting crushed? Well, we need to compare this most recent observation, 87.7, to what the implied volatility was doing the end of day, the day prior. So just like we track stock price on the day, right? NVIDIA was down 3.3. We're going to track the implied volatility on the day. So this negative 3.3 is what the stock did from previous day's close. So this implied volatility up by 15.7% is the implied volatility moving higher and increasing by 15.7% from the previous day's observation or ending closing value. And then next to it, we see the option volume, which is 1.26 million option contracts that traded in that expiration. So in NVIDIA, November 22nd, expiration, 1.26 million contracts traded. That's also important because it lets us know the trading volume behind the move. So sometimes you might just have a wide option with zero trading volume, and maybe the implied volatility moved higher because the dealers are moving around their bids and offers that could be pegged to other things that are making them go up or down, or the markets are just very wide. But here we see that there is a lot of trading volume behind those option values, 1.26 million. So when we think about implied volatility, we could think about, well, what does it translate to in terms of moves or volatility? Because we got this number, 87.7, we got 72.5, 64.1. And, how do we put it in a different perspective of what the options are signaling? What are they telling us? I have this number, but how do I look at it a different way? Maybe a little bit more meaningful insight. So besides the implied volatility, which is basically the market's signaling of what the future volatility will look like, we could also look at the option straddle based on this data and say, well, if we had a perfect at the money strike, and we created a synthetic straddle, call and a put, and we compared that straddle to the stock price and said, well, what would the percentage move in the stock have to be up or down? What's the required percentage move for that straddle to break even between now and expiration? Okay, so that's the implied move. So then we're going over here and saying, well, this translates to a 9.8% move up or down between now and expiration. And that would be and it has 6 days to go. Okay, so now we have two numbers. We have this 87.7, and we have what the straddle value in percentage terms is valued, right? So 9.8%. You could see here, you have in NVIDIA, November 29th, you have an at the money vol 72.5. This has more trading days to go, 10 trading days, or 10 days to expiration. But the move here is 10.9%. Okay, that's the required move, even though there's a higher implied volatility, but you have more days to expiration, and the stock move has to be greater. So that's what we're looking at here. Two numbers, at the money vol, the change in at the money vol, and then we have this straddle value. So if we have this straddle value, how do we compare that to a benchmark to see, well, is it on a high end or low end? If we just look at the premium and take it from the perspective, what if we bought the premium and just held on to it? And instead of trading the Black-Scholes model, which is, you're trading the implied vol versus the realized volatility, which requires you to hedge your deltas and trade your gamma. What if we just looked at the straddle, held on to it, and how does that compare to the historical stock moves? If we measured the historical stock moves, from start to finish, given the amount of days left to expiration. Okay, so if we looked at the same trading days historically, and let's just say, let's take the first one, 6 days. And we looked historically and said, well, between now and expiration, there's this many trading days. If if we went back in history and said, well, how how much did the stock actually move in those given those amount of trading days, right? Because the stock, when you have, let's say, 1 minute, it's not going to move by the same magnitude as if you had it like for 1 month, and in 1 year the stock could have a much greater move than in 1 month or 1 day. So if we added time, the same amount of time, and we looked at the historic stock moves, what did they look like? So then we could compare it to what the options are implying. Okay, so this here looks at the historical absolute average move in the stock. How much did the stock move up or down? Because in this, when we look at a straddle, it doesn't matter if the stock moves up or down, because if you own a call and a put, you just need it to move by a big enough percentage to cover the cost of both options. So even if the stock's going down and the put is making, going up in value, and the call is going down in value, well, if the put goes up in value by big enough um, increase to compensate for whatever you lost in the call, then it would be profitable. If the stock goes up and the call, the appreciation in call exceeds the depreciation in put, then it's profitable. So we're looking at a straddle here in either direction, and we're saying, what is the average move, in absolute terms? Doesn't matter up or down. So this is telling us the average move is 8.4%. Okay, so 8.4% is the average move in NVIDIA given these same amount of trading days. So now we have these two numbers, right? We have the implied straddle, the average, and if we just wanted to, and how far back are we going? So this is telling us we're using 6 years of data. Okay, so this is telling us going back 6 years of data, this is what the average is. And these are just our starting points. You could go and use the calculator to change those dates. If you want to try 1 year, 2 years, 3 years, you have that flexibility. It's a different tool, but we're going to stay on this one for now. So we have these two numbers and we want to compare them, and we could compare them by creating a ratio. Well, what if we took the straddle, the implied move, and divided it by the historical average move? Then we get a ratio, right? So if this is greater than this, right, you'll have a ratio more than 1. If the implied move divided by the historical average move is lower, the implied move is lower than the historical average move, then you're going to get a ratio less than 1. So now we could just look at ratios, and then we could kind of even compare them, the ratios, right, versus each other. This allows us even to look at, within NVIDIA, we could see how these look relative to each other. So even in NVIDIA, the further you go out, you see that the ratio is declining. So at 1.2, we know that the implied move right now is above the historical average move by that magnitude, 1.2 times. Okay. In addition, we could just, here we didn't put the range, the high to low, but we just put the max move. So in historically, if we looked at our data set, this tells us the largest move we've seen in our analysis in that data set that calculated 24.6. So obviously that's much higher than the 9.8, right? So this lets us now also run a ratio relative to the high move. Like how far away is the implied straddle relative to the highest move? So if you have a very high ratio, let's say 1, then the current straddle would equal, if you have a perfect 1 ratio, would equal the biggest historical stock move we saw in our data set, okay, in that date range. If it's above 1, that would mean that the move implied by the options markets would even exceed the biggest move we've seen historically in that date, given that date range. All right, so those are kind of the numbers there. So let's say we were, okay, and over here, a couple more things. If the, obviously options expirations can cover certain events that we may be able to anticipate that create more volatility. One is earnings. So over here we list next earnings when we detected it. So here NVIDIA is expected to report earnings November 20th after the market close, which would explain a higher implied vol. And if there's another event other than earnings that we detect, that we're compiling information, we will put there in here in this box. So if there's like an upcoming announced industry conference that they're going to participate in, or maybe an analyst meeting, investor relations meeting, then if we detect it, we put it into our database and it will appear over here. Now, given this, the one thing this is doing also for us is that when it detects there's an upcoming earnings as such, the database analysis knows this, so it will filter out dates that cover earnings. Okay, so this 8.4% will include dates that cover earnings, and it will take out data that do not cover earnings because stocks move differently on earnings than non-earnings, right? We know that during earnings, you will have that earnings impact or earnings effect. So this way, to line up the data with the earnings, the system detects it and knows that, okay, if we detect the earnings, isolate the data in our database that covers the earnings, same as we have here, 6 trading days with earnings coming up, and analyze that data. So this is saying that in the last 6 years, if we looked at the historical moves over this amount of trading days with earnings coming up, this is the average move with the high move. So now we have these different ratios for that. Let's say we wanted to look at just expirations that are closer to expiration, right? So the shorter dated. So we could use this filter up here, expiration, and let's say we want next 7 days. So if we click on that, now all of a sudden you see expirations November 22nd. So you can see these expire within the next 7 days, and we filtered out all the expirations that are beyond that. So if it's 30 days to go, 20 days, 8 days to go, those are filtered out, and we narrowed down the options that were analyzed. So now we have NVIDIA, Apple, Microsoft, and this also allows us to compare them relative to each other. And here we could kind of see now we have these top market cap stocks. All of them were down we're not open yet today. These are Friday's close. They were down on the day. Tesla was up, but all these were down. Um, and the implied volatility in November 22nd increased in all the options, right? So it wasn't that they kind of all moved in the same direction. So kind of we could say that this was um, market, reacting to systemic or market factors, because we don't see, some would be up, some would be down, but they all look like they're kind of, you know, all moving up based on what the market was doing. Um, then we could look at November 22nd over here, and we could just see the differences in what each of those straddles implies. We do have the implied volatility. We could also over here for convenience, we just see what does that translate if we just looked at the straddle premium, or the required move, we could compare those. So NVIDIA has the highest, but it also has a earnings coming up. And at the same time, we could just take a look at their ratios. Well, how does the implied move compare to that historical move for each stock? So we could see the ratios as well. 1.2, 1, 1.1, 1.3, 1.3, 1, which of course, now we're getting a sense on a relative basis how things are priced, right? Not only by stock, but we're looking at groups of stocks on a relative basis. We could even see versus SPY here. If you're doing a dispersion, let's say if you're selling indexes versus buying, some of those components and doing a dispersion. Well, here's a way you could just quickly compare them to see, where the markets are lined up, where they priced higher and lower relative to those historical relationships. Okay. So that's over here. And again, we can just compare, what about the max move, right? So I'm going to come over here and let's look at higher market cap stocks. So let's just do above 50 billion. So now we narrowed down, from originally 2,865 items to 155. Okay, and that's because I use filters here. I changed the expiration to show me just the next 7 days, and market cap $50 billion or higher for the stocks. So let's say I wanted just to sort by the highest ratio. Right? Let's just sort that way. So we could click on here, and now it's sorted from lowest to highest, but let's say highest to lowest. I sort again. So here, Amgen, the current straddle is implying a move of 6.5% November 22nd. Well, how does that compare to its historical average move? Well, historical average move is 2.5%. So that's 2.6 times its historical average move. Now, Amgen could have, we see there's an event here. So you could see here that they're going to have a conference, presentation, maybe there's something else going on that could justify it. So that's the next step is the why, not just that it exists, but we need to know the why. Like, what is the justification? Why are the markets pricing it this way? It's important to go and do that research afterwards. This is our starting point. But we see that for whatever reason, the markets are pricing in a higher than average move in Amgen. Here, Boston Scientific, and these are healthcare stocks, right? They're pricing a 4.6% move versus a historical average move 2.4%. That's 1.9 times itself. So this is a quick way just to sort that out by highs to lows. Okay. And if we wanted to go lows to highs, of course, just click that. And here we could see that they expect to move in this stock. PDD is 9.5% versus a historical average move of 19%. Here's one. This is energy transfers. One expect to move 1.6% versus a historical average of 2.2%. So let's now sort it one more way. What if we wanted to see how close is the straddle relative to its high move, right? So not the average, but the high move. So we could sort it by this. This is lows to highs, highs to lows. So far into it, if we took the ratio, its highest move is 10.4. So if we took 5.5 divided by 10.4, that's a ratio of 0.5. So nothing here that is close to 1 so far, right? So these are kind of even if they're above the average, we don't see anything yet in our analysis that's getting close or above the highest move we've seen in history, given this date range. Let me go down a little bit and let's see if I add from 5 billion market cap. So now that we've resorted, we should have now we have 302. So still 0.5, nothing showed up. But we were able to quickly do that analysis. If anything, there would have been close to its high, we would have been able to detect it in this table. So I'm going to stop there with this analysis.
Yeah, that was great, D. Another great webinar. Thanks for doing it. Thanks for all the chameleons who joined today. Any new users coming by, thanks for stopping by and checking out the webinar series. Great job, D, as always, my friend.
All right. Thanks, everyone. Stay safe. Have a great trading day. We hope to see you guys tomorrow.
Trade in peace, chameleons, everyone.